FinTech always looks sexy in reverse once it's already built and you have a big user base. People just went out and said, okay, copy paste from abroad. This is exactly what's going to work over here because it worked over there. Guess what? Local dynamics are different. One from regulatory, two from consumer behavior. SaaS, for example, did not really work, and I think till this day is still problematic because people are not willing to do subscriptions for certain products, especially when it comes to FinTech.
People need banking, people don't need banks.
FinTech was what AI is today. So everyone and their mother wanted to throw money at it no matter what the valuation was. You got $100 of stablecoin abroad, you don't want to bring that in. I'll give you $70 of that domestically in local currency at a rate. Default on me, I collect on the stablecoin. If not, then you pay me domestically, I'm making money on both sides.
The funding winter has carried on, let's be honest. You might tell me, no, it hasn't, but generally it's been from a sectoral perspective.
What I will say is that I think funding winter is over.
Hello, ladies and gentlemen, and welcome to today's episode of Couchonomics with Arjun. Joining me, not for the first time, but for the second time, is Omair Ansari, who is the founder and CEO of a company called Abhi. And if during the meeting or during this podcast, you hear me start calling him Abhi, is only because I have a cousin called Abhi. And so that mistake might happen. But having said that, it's good to see Omair. He's on the couch. He's not wearing a pair of shorts this time.
I was thinking about it.
Yeah. And that doesn't it sum up? You're an early stage startup in season one.
I can afford pants now.
Yeah, you're now an established founder. Right?
I can afford pants, got better shoes, not slippers. It's all part of the journey.
It is all part of the journey. But no, let me start with actually congratulating you, right? I've kind of sort of followed your journey over the last sort of 3 or 4 years. We've had, I don't know, several conversations. You're one of those unfortunate few who doesn't need to speak to me or chooses to speak to me. I guess self-inflicted pain is the way I would say it. But no, thanks for coming back. And I thought in season 4, I wanted to bring back a few people from previous seasons just to kind of talk about, how's the world evolved and sort of take different perspectives. So, you're the first victim out of that sort of repeat crowd. So, Omair, let's kind of dive straight in, right? Since we've spoken about you've ventured into multiple markets, and I don't need to sort of name them. They're Pakistan, UAE, Saudi, Bangladesh, so on and so forth, right? Let's take a 100,000 feet view in terms of how has the overall sort of fintech sector evolved, and secondly, have you seen some level of splintering? And I expect the answer should be yes, but again, I'll be corrected by you across these various markets in terms of what's kind of leading the charge in terms of the transformation?
So if I remember right, we had our last session before the interest rate cycle went up.
Yep.
Right? So we had...
And that's the session that you and me had, not the podcast.
Not the podcast.
Yeah,
the podcast was also prior to interest rate cycle,
yes,
I think.
It was.
So a lot's changed. That was when FinTech was what AI is today. So everyone and their mother wanted to throw money at it no matter what the valuation was. I always tell our team that we were lucky, not skillful through that cycle. And we were the right place at the right time. And so we raised a decent amount of capital. We went out and we executed. But what's changed significantly is that business models have now had to adapt through that change of cycle that happened from a funding perspective, which meant that free money was no longer there. Valuation suddenly became important and unit economics became important. Mm-hmm. Luckily for us, from day one, we focused on that. And so we were profitable like 6 months into us launching the business. But a lot of the fluff disappeared. That was kind of step one. So the competition aspect of this completely got decimated because they raised with the hope of being able to raise in 3 to 6 months. And that didn't happen. So I think that's one aspect that just changed from a competitive dynamic standpoint. The second aspect of it was then, okay, who's left and what is it that you're actually providing as an end product that is viable? So people had to go back and realize copy paste doesn't work. And I think that's what happened across emerging markets as a whole and over here in Pakistan, et cetera. People just went out and said, okay, copy paste from abroad. This is exactly what's going to work over here because it worked over there. Guess what? Local dynamics are different. One from regulatory, Two, from consumer behavior or business behavior in terms of what you can sell. SaaS, for example, did not really work, and I think till this day is still problematic because people are not willing to do subscriptions for certain products, especially when it comes to fintech. And so what it required a change of mindset was, were those operators able to change the actual business model which they had gone and raised for, to then go into survival mode and say, okay, is this what the market needs? What is it that the market needs? And let's pivot to make sure that we are providing a product that we can actually sell and make money off of. And I think that's the discipline that has been enforced into the segment for the past 2 to 3 years. And so now you have a much more mature, I think, element of founders that have been able to survive the winter. And that's the key for all these cycles. Winter comes, winter goes, but can you come out the other side alive? And that's where I think the big difference has been now compared to when we spoke last time. It literally was what AI is today. And I think now, finally, quietly in the background, fintech has started to ramp up again. And we'll talk about funding later. But I think now you have mature founders who have good products who now need to understand how to scale those.
So it's interesting, and we will talk about funding. We'll talk about some of the regulatory perspective, and I will take a little bit of a deeper dive just to understand what's actually happened in Pakistan versus Singapore versus Saudi Arabia versus the UAE. But I think you mentioned a very interesting point around business models, right? So I remember meeting you 4 years ago. You were again in a pair of shorts. We met at a coffee shop, and you explained to me what earned wage access was, and I'll be honest with you, I didn't have a clue, right? But it's been a very interesting journey for your business model, right? You started with earned wage access. You then started doing some level of invoice factoring and working capital financing or liquidity financing. You've done salary financing. You've now landed up buying a whole bank. Congratulations on that, and I hear it's doing very well in Pakistan. So was that always a part of the plan, or are these, if I may call, sort of adjacencies that naturally came through, or were these, the primary business model is really not scalable, so therefore I need to add? What was the kind of thinking around it? Because it's also kind of hard for you to communicate the story, isn't it? Because it was very easy. I'm an earned wage access player. Now all of a sudden I'm a bank.
Exactly.
So walk me through that journey and sort of why that happened and how that happened.
So I won't lie and say that this was a grand plan that we mastered along the way and kind of picked up the pieces. What it was the only part of it I'd say that we knew from the beginning was that EWA in itself was not going to be the be all and end all. Why? Simply because I've seen this across other markets as well. EWA in itself is a great product to be able to build your user base, but because of its nature of being short duration and low ticket size, which means, look, the average duration is 12 days and the ticket size is in the UAE, it's about, say, 400 to 500 dirhams. Very short duration, but the stickiness aspect is also there, but the barriers to entry are very low. So what ends up happening is if you make that your only product, you will end up having competition come in who is probably in another space and offer that for much cheaper or free, and your business model disappears. So what we knew from the beginning was this is a very good product to be able to get the user base because it's understandable by the market. People understand salary advances. They may not understand EWA, but they get salary advances. And most of the time, to be honest, everyone calls it a salary advance, even though it's not. But it allows you to get the user base very quickly. So we were able to build our user base super quick comparatively to a lot of other players in a very secure manner as well, not B2C, where you can spend a lot of money and have a lot of NPLs on the back of it because you don't know where you're collecting from. Mm-hmm. So we said, okay, this is the way we build our user base. However, what changed over time and why we stepped into the working capital financing, at the end of the day, these economies are made up of SMEs. So we got your Unilevers of the world. We got the large companies to sign up and give us that proof of stamp where the rest of the industry got FOMO and therefore wanted to bring it on board. The difference between a large company and SMEs is SMEs, CFOs, CEOs, HR really don't care about the employee base as much as a larger company does.
And as much as they should.
Or as much as they should. And look, that's a reality of the fact.
It's
just
always been the reality.
So you can be there, financial wellness, et cetera, and all that. But they're like, look, how are you helping me? As a CFO, for example, of an SME, how are you helping me? I get you're helping my employee base with this, but that doesn't really do anything for me. So your priority drops this low in their list of things to implement. So when we said, okay, you know what, if our stumbling block comes down to when we're a B2B2C enterprise player and the CFO doesn't want to bring us on, what will cause a CFO to bring us on better? And that was basically fixing their problems, which was their working capital cycle. So allows us to essentially do two things over here. One, suddenly speak the same language as someone who wants a product to us to bring on. So working capital cycle, like you mentioned, invoice factoring, payroll financing, etc. Happy days. The second part of it is risk mitigation. At the end of the day, when I'm doing this for Unilever, for example, I don't have to worry about payroll. SMEs, you do have to worry about payroll. But for me to underwrite the business, do you think the CFO is going to open their books to me if I'm saying I'm giving your employees money? No, they're not getting me any data. While if I say, listen, I'm going to provide you with working capital solution, but I need to look at your books to be able to assess your risk of your books, they'll open it up to me. So then I'm able to cross-reference both and say, okay, now I'm able to serve the entire stack. So that was a natural evolution of us along the way. And again, nothing I'd say from day one thought would happen, but that was a stumbling block where we hit a decent amount of users and businesses that we brought on board. But then at a certain point, we realized we hit a stagnation point because SMEs did not necessarily really want this product.
So question for you, right? It's easy to talk about this in terms of the evolution from a strategic perspective, right? And this is one of the things I keep saying, that commentators like me have an easy life, right? We're half intelligent, we come up with this. How did you need talent, you need technology, you need new capabilities. How did you navigate all of that, right?
So,
was there a reason why you did it quicker, faster? Was it because you were positioned in Pakistan, which does have a large talent base? So sorry, I phrased the question again. How did you manage all of that?
Manual. There's no tech. I think this is one thing that a lot of people get wrong. FinTech always looks sexy in reverse once it's already built and you have a big user base. But at that time, if you want to test to go live, and our product team is key on this, it's do it manually. So give background, by the way, when we started EWA, it was purely manual. It was my co-founder and I on WhatsApp putting up posters and saying, if you want your salary in advance, WhatsApp this number with your bank account details and how much you want. And then we'd go to our online banking account and IBFT. It's not scalable, but allows you to test quickly and understand if people want it. Same thing when it came to this. So we said, you know what? We're hitting a stumbling block. So we need to go and start speaking to the customers again, because we had fantastic pipeline. And sales loves coming back to saying, we've got this pipeline. I'm like, screw the pipeline. I want to know what the conversion is from pipeline to actual revenue generating customers. And that's what it's talking about. It's okay, let's go and meet all the customers. What's the problem? That's where the problem came out, saying, well, help us and we'll help you. Said, okay, working capital solution. We weren't going to day one go and build an elaborate tech platform for them to use. We said, okay, how do we test this manually at first, which was email correspondence. Here's some documents we need from you from a KYB perspective. Please send that to us. Our underwriting team will use Excel to underwrite it. Send it back and say, this is what we assess your business as. This is the limit. Do you accept? The only technical part of this was probably a DocuSign. We said, okay, here's a DocuSign. Check. And then we would disperse the capital. When we did that enough times, that's when we understood, okay, one, the product is scalable. Two, people want it. Now let's go and build in parallel so that we then have the capability of actually making this a large business and not doing it manually. So that's one thing we do with every single product feature that we come out or new products that we come out with. Manual first and then automate.
So interesting, right? So let's take that a bit deeper, because I've got this one. So as you actually matured, or you started having water flow under the bridge, as they call it, in sort of large abundance, you started developing credit models, right? And you build credit models on typically what I might deem thin files, whether it was for a consumer, right, who would be typically a blue-collar worker who remits 80% of his money back home, right, or small businesses who generally are thin file. So are you now at a stage where you have built incredibly robust, dynamic credit models that you could go into the market and possibly do most types of credit?
No, we're not there yet. And the market's not there yet. And this is with the whole thing of open banking and AI, et cetera, is just not there yet for these markets. Look, 99.9% of our customers have never touched formal credit in their life. They don't have the audited accounts. They don't have the basic requirements, hence why they're not able to access a banking line, right? So do we have, based on certain sectors, parameters that we look at? Absolutely. And it's allowed for now the speed of execution on the underwriting process to be much faster when a certain company within a certain sector comes to us. But is it automated to the nth degree where it's data in and out saying yes or no? No, we're not anywhere near that yet. And I don't think anyone is near that in this region, because you just do not have the compliance. I mean, look, taxation has only just come in, for example, in the UAE, which majority of companies still do not comply with. Everyone still gets the text messages saying, hey, it's coming up. If you want to get fined, make sure you comply, et cetera. That's still happening. So the data, it's garbage in, garbage out. So if you try and set an algorithm on these things when you know the segment you're dealing with does not have that, there's no way you're going to be able to build something like that. If you go, the only segment that has this is the one that's already banked.
Yeah.
And then that's not my segment. I'm then competing with the bank's going to undercut me every day. I won't be around. So in the segment I'm in, we're nowhere near that yet. And look, I think that's the opportunity side.
Okay. And makes sense. I was going to say that's where the opportunity lies. Yeah. Let's talk about, so we talked a little bit about technology and compliance and so on and so forth. Let's talk about the capital side, right? We'll take capital in two ways. One is the growth capital that you need to basically, I guess, lend, right? Because there is a balance sheet play in your case. The other form of capital is for you to sort of scale your business, right? Whether it's new technologies, hiring more people, opening offices. Let's take either one or the other first, right? Let's talk about just growing your own business. The funding winter has carried on, let's be honest, right? In the sense it's still been quite hard to get money. You might tell me, no, it hasn't, but generally it's been from a sectoral perspective. We've seen some new types of investors walk into the, quasi-sovereigns or sovereign-funded investors. We've seen some interest from the CVCs. Has that changed the dynamics at all in terms of how you raise money? Is it different kind of money? I'm keen to hear your views.
Yeah. Look, I think the region, and I say region, I say it's really UAE and Saudi, and a little bit of Qatar, has been in a bubble comparatively to the rest of the world. So everyone externally has been coming here to raise capital, as well as domestically, everyone's trying to raise capital from the same people. So that's the only aspect I'd say which has allowed for a lot of local companies to stay afloat. And you not only have some of the VCs that have been set up and family offices, but also I'd say, as you mentioned, the CVCs that want to be able to level up their game when it comes to having a technological play. And that there's always interesting two ways around this, right? It's an innovator's dilemma, where you have companies that say, you know what, we're going to go and build this ourselves, or we're going to go and invest in various entities and make ourselves look and feel like a fintech or a technology company. And I think that's where you've seen an interesting aspect in the Middle East specifically, where you've got these legacy entities that have realized they've got big, massive, fantastic businesses, but their valuation is a price to book. And the valuation on that is typically 1 to 1.2 times, if you're lucky. Mm-hmm. While if you have an element of fintech on board, suddenly that jumps. And so I think that's where it's been interesting, at least for us as well, is to work with some of those players and understand that and work with them so that they can come in as kind of strategics into the business. And I think that's what you've seen across from other fintechs as well in the region. But what I will say is that I think funding winter is over.
Okay, so that's interesting. And you used the term that we've been in a bit of a bubble. So have we kept some really subpar fintechs alive?
Yes.
And so what happens now that the fintech winter is over? So they bucked the trend and they will live forever?
No, not necessarily. I think the next round of growth investors, because there's always been this talk, this dry powder. And I think a lot of it's been reserved for AI and has been pushed there. But now I think there's a proper amount of capital that's going to be coming back to EM in general, and specifically for growth equity. The parameters and the requirements of those investors is very different from the previous cycle. So I think there's still a bunch of zombie companies that are out there because they had raised a lot and they will chug along, but there'll be value traps. I don't think they die tomorrow, but unless there's something that dynamically changes with the business, they'll continue to kind of go in decline. But those that have a strong business model, they will then be able to benefit from this, I think, end of winter cycle that's happened. I think we're in for a strong tailwind.
Interesting. So the other side of the raising the capital. So you obviously started getting into invoice factoring, working capital financing, and so on and so forth. And I think you took a cognizant decision that some amount of it you would sort of fund through your own balance sheet, but some of it you would have to raise externally, right? So how easy has that been in terms, well, nothing is easy, but how easy has it been to be able to convince, if I may say, some traditional lenders to sort of see a fairly, if I may say, tricky picture, right? Because they themselves have not necessarily exposed themselves to particular segments that you're going into. So how have you kind of gone through that whole process of convincing them to say, give me this line of credit and I'll do a better job than you can?
So traditional lenders, no. I've just don't have that conversation anymore.
All right.
It was early days where I said, okay, we could try. But the point is now the private credit industry is massive, and it's specifically in the region. I think you have everyone and their mother now have set up a private credit vehicle. We have at least 3 to 4 different private credit vehicles that approach us almost weekly. It does, and two views on it. It's something that's growing globally as well. You look at where it is in the US and where we are here, it's still tip of the iceberg. But point being that there's enough credit out there now, which it needs a home. So your ability actually to raise debt capital now in the GCC has become increasingly easy. You do not have a problem if you have a decent business model. Now, what the scary part of it as well is people who don't have decent business models also.
And they're still getting funding.
They're still getting funding. And this is where, to your point, is scary, because the problem is on the investor side, they think they're protected because they have warrants, which is equity in the business. The problem is the equity could be worth zero. So you're not really protected. So it'll be interesting how that plays out. But from the debt side, though, to answer your question,
and my fear with that is that actually, they could actually harm the market. And I think, what we need to understand is that, as dynamic a market we are and as buoyant a market we are, we're not a very big market, right? And there's only so many blemishes and so many sort of debacles that this market sort of swallow, right? Or absorb, if I may use that term. Let's talk, funding is great. Let's move to the next favorite topic all you founders have, which is regulation, right? And regulation and new business models that are emerging. And I think, it's quite interesting that regulators are increasingly playing the role of market makers in terms of, encouraging certain business models. So I'll kind of lay a few of them which come to mind, and then you react in terms of where you believe that these are really, really taking shape and, how they're actually impacting your sector, more widely. So, we've talked a lot about open banking, open finance. It's been a bit of a damn squib in Europe and in the UK. It hasn't really kind of garnered what it was supposed to, the revolution which was supposed to happen. At least I haven't seen it, right? Here also, I think we're kind of slowly chugging along. We're getting open banking opened up in Saudi. There's an open finance play coming out here in the UAE. I know Bahrain's been slightly ahead of the curve. We have some very exciting stuff happening in the UAE around digital assets, specifically crypto. Yesterday or a week ago, I think the digital dirham primer initiative sort of got announced and so on and so forth. Sounds quite interesting. They're looking at a retail CBDC, so on and so forth. We have digital banking licenses which are being issued. I think Qatar has been one. I think Pakistan has been the other. So my question is 2 or 3 level questions. One is, yes, regulation is becoming increasingly an enabler. And I have to agree with it because 5 years ago, it was definitely not one, right? But is it becoming easy to navigate? First question. Secondly, I don't see much regulatory harmonization happening, even within blocks, sure. Right? And to me, that's kind of like counterintuitive, and it kind of works against innovation because in a small region, you want innovation at scale. You want innovation to be sort of tested properly, right? And this kind of sort of holds back the lack of regulatory harmonization. But at the same time, if it's not harmonized or if it's early days, if you're able to kind of, I guess, use it to your advantage, you can create a moat quite quickly, right? Start using regulation as a moat because you were sort of first. Where does your head sit as a founder operating in multiple markets, having to deal with this in multiple ways?
So I think it's a fool's game to think that there'll ever be harmonization between the regulators. I was surprised to know even within the EU, for example, that you have a banking license in one country does not mean you're necessarily able to lend in another within the EU bloc. Should be the case at the end of the day. You're all under the ECB, etc. Should be fairly straightforward. Why would you have that here then? So I think harmonizations, and I've learned that, whether it be, as you mentioned, we're here, we're Saudi, we're in Oman, everyone is very different. And the pace is also very different. And the acceptance is very different. The only thing I'd say, which is now ubiquitous amongst all regulators, and that's region and as well as in Pakistan and elsewhere, there is no more gray area. I think that was what was interesting, which was for about 2 to 3 years, was everything was just like kind of gray areas. Like it's not lending, but it is, but it's technically not. And yeah, you can get away with it for a period of time. Now there's no such thing. No regulator is willing to say, no, it's a gray area and we'll just give you some sort of document so you can continue. Mm-hmm. There's a clear definition of saying either we consider it lending or we consider it regulated activity. And this is the path to be able to get to it. And so you have to be regulatory first. And that's what we've done across our markets, no matter where we go. The pace at which the acceptance is different across the different markets, but you have to accept that as an operator. The second part of it is then saying, okay, if I cannot go and get that regulation myself, how do I then go and work with someone who has that? And this goes almost into what you were talking about before, of CVCs, et cetera, is now starting to play the game because it benefits both sides. So for Saudi, for example, with us, Al Raida is now an investor in the business, but significantly important for us because they give us a huge amount of regulatory cover when it comes to Saudi. They've been there for years, PIF backed, all the bells and whistles. It allows you to have legitimacy in a new country with the regulator as well as domestically with a new clientele base as you then progress to get your own licensing along the same way. So I think you have to be very pragmatic and not live in a world of saying, I wish it was this, and then you sit back and huff and puff and nothing ends up happening. You have to deal with the hand that you're dealt. And I think each of these markets is very different from each other. And you have to be able to say, okay, go to the regulator first, ask them about your product. What can I do? They will be open with you and tell you whether they consider it a regulated activity or not, what the path to be able to doing it is. Then you go away and figure out how you can go live if it is a regulated product quicker compared to going and get your own regulation in place.
Okay, so I've got one question, and I think, I'm in complete agreement with you. as you said, there's no gray area. It's all getting black and white. But are we regulating fintechs commensurate to the size, scale, and impact that they have? Or are we using banks as the sort of template and arguably, in my view, punitively regulating the fintechs and not giving that flexibility? Because the fact is, you just don't, to take on a bank on day one is hard. And do you have that fear that we are heading towards that sort of, I won't use the word over-regulation, but I don't have a better word, so let's call it over-regulation. Or do you think the regulator is being able to sort of balance the scale?
I think historically it was more the former. It's becoming more the latter, where they are balancing it. The sandboxes, etc., for example, is reg light. However, they're not being naive about it. And the saying goes, every fintech dreams of becoming a bank. So the idea is that they know that the be all and end all for you eventually is most likely going to be a bank. So how do you along the way make sure that you're beefing up your compliances to hit that? And it's a different world. I mean, we bought this bank, for example, in Pakistan. We have a professional CEO and a management team that runs that, because guess what? The regulatory requirements of being a bank is very different from being a fintech.
I totally agree with you.
But if you eventually are aiming to do that, you may not have that skill set. So I think what happens is, what's happening now is there's sandboxes you can go through and you can complain about them. But what it does is it gives you the capability of really doing it in a soft manner, allows you to be live. The slaps on the wrist as opposed to complete shutdowns, and you slowly mature, which is a much better way than going out and saying it's a gray area, only to realize you'll get a massive fine. And these fines are big. Right?
No, I totally appreciate it. I think my view is that, there's another friend of ours, and he's a common friend, and he's been on the couch, and he has this line which he uses with me again and again, which is like, if it looks like a duck and it quacks like a duck and it sort of, I guess, swims or floats like a duck, it's a duck. But that's the bank's perspective, because what they're saying is, why are you lightly regulating these people who are coming and having our lunch, right? But there's good reason for it, right? The banks don't see the good reason, right? And that's kind of my fear, which is, and the banking lobby, let's be honest, or the banking influence, rather than use the word lobby, will always be that much greater, because they control that much more of the country's monetary and fiscal policy, and so therefore they have that influence. Interesting. Let's talk a little bit about, you mentioned Saudi, you mentioned you're working with Al Raida, who's providing you, I guess, regulation as a service, banking as a service, right? We've talked about embedded finance, and I think a lot what you offer would fly off the page if embedded finance was sort of truly coming to life, right? I sat last year at 24 FinTech, which this year is going to be Money 2020, and I don't know if this episode is going to be out by then, but assume, let's be honest. And I sat down and I spoke quite grandly about how the time for embedded finance is now, and I kind of bored the audience with a 90-second monologue. A year later, personally, I'm not kind of impressed by the amount of, I guess, progress we've made on embedded finance, SANS, payments, and BNPL. What's been your experience in terms of embedded finance truly coming to life, maybe on the B2B sector, not the B2C necessarily, but in your case, there's B2C and B2B. And secondly, is the reason regulation, or because banks have really not figured out what banking as a service means? And if you don't have banking as a service, it becomes harder to do embedded finance.
So banks will never do embedded finance. I don't think they would understand it. And for them to be able to outsource that part of their business, one, they don't have the technology stack to be able to do so. So I think banks you leave completely aside. In terms of embedded finance, has it worked? Has it not worked?
Or has it progressed? I'm sure it'll work, but has it kind of progressed in the last 2 years?
Look, again, it's one of those things which the term embedded finance was literally created 2 years ago. And so these buzzwords come around of industries, and before we were a financial wellness platform, it's like, no, actually you're an embedded finance platform. Like, our product's exactly the damn same. But it's the taglines that people kind of associate with it. So has it progressed? Absolutely. We are embedded into our partners that we provide our cross-financing to for businesses and individuals. It has only grown since 2 years ago. And the more and more we do it with larger enterprises and small enterprises, the more it continues to grow. But has it become what I think everyone again extrapolates when they have a new buzzword around industry? Possibly not. Same way that I think even digital banking or open finance as well, open banking has not also met the crowd, because everyone, again, extrapolates so quickly and thinks it's going to happen like this, when actually it takes about 10, 15 years before it actually happens, maybe shorter than that. The point is, it takes time. It takes time. So I think, for example, we'll be sitting here in a couple of years and it probably won't even be called embedded finance anymore. It's like, oh, actually, no, it was all digital banking to begin with. It's like, okay, yes, we were a digital bank. So I think that's...
And even digital bank today has become phygital bank.
Exactly.
So that's a whole different point. Right?
Exactly.
So, no, but okay, let me pivot the question, because whether embedded finance works or not, but I'll tell you, one is a very real question, right? Which is, are we finally seeing fintech play a key role in infrastructure positioning?
Yes.
So are banks now coming to Abhi and saying, you know something, I want to launch this, I don't want to build my own stack, I'll integrate your stack.
Banks, no.
So banks are not doing that, right? So who's doing that? So who is saying...
Businesses. So companies, this is one thing that's... Look at Emirates.
Yeah.
Right? Emirates issues its own credit cards now. That's embedded finance. They're moving away from your bank, right? And that's the whole point. And I think this is where the traditional banks, and digital banks as well, but traditional banks are really facing a conundrum, because their customer base are actually themselves becoming digital banks, right? Think about Shopify. Shopify is in itself a digital bank through embedded finance, right? And so I think
for me, it's the poster child of embedded finance.
Absolutely,
right?
Absolutely. And so I think that's where it's at. The banks are not doing it, because the problem is...
Although the banks are at the back end of it.
BS. Complete BS.
Omair, the balance sheets are all coming out of that.
Sure, but the balance sheet is going to become ubiquitous. So first of all, balance sheet is like being a cotton trader, right? It's commoditized business.
So you're saying private credit will come and just displace
Forget
the banks?
credit. I mean, we'll touch on crypto as well. I think that when it comes to balance sheet, credit is going to become so commoditized that this theory of, oh, I've got a big balance sheet behind me, is going to disappear. That's not your moat, and nor should it be your moat. So, and the problem is as well, is your traditional banks, again, investors, and I've dealt this with like 11 different banks. The problem is they all set up this innovation lab and they want to become a digital bank. Name me one traditional bank that has been successful at becoming a digital bank.
DBS.
It's a completely separate entity though. And that's the point. So I think that the banks, so no bank is coming to, because when we've gone through, we literally have MOUs with 12 banks at this point in time. Have any of them come to fruition? No, because what ends up happening is someone inside says, we can do this, we can do it ourselves.
Incumbent banks cannot
we'll
launch.
Do it ourselves.
They can't launch.
So who is doing it is our partners that we work with. So for example, the UAE, Al Fardan, Lulu, Al Ansari. These are companies that are becoming digital lending institutions on their own and saying, I don't want to build this myself. I don't have the capability of building myself. And it's stupid to build it myself. Let's go and work with these numerous fintechs, bring it together as a stack, and provide it as a service to my customer base. That's where it's working.
So banking as a service has kind of evolved. The word bank, it doesn't have to be providing banking, and I think that's kind of where it goes, right? People need banking, people don't need banks. It's interesting you say that balance sheets are commoditized and are definitely not moats. Do you think that will be the case even in this part of the world?
Eventually. So I have a grander thesis when it comes to, and this goes into crypto. As adoption of digital assets happens, no longer is bank balance sheet the only form of credit for you to be able to fund balance sheets for or credit globally. You could theoretically, if everyone, let's put a very simple example, and we're doing this right now. Imagine that we have built our entire stack on blockchain. right? And we're issuing our loans in stablecoin. We have off-ramp, we have on-ramp, right? Someone who owns that stablecoin somewhere is looking for yield. Right now, the average yield is essentially where US Treasury is, right? But if I have liquidity solution and on-ramp and off-ramp capability where I am lending, for example, to someone in Riyadh, and I'm generating a yield in that product of 35%, right? Why can I not just put that up onto the platform where someone in the middle of Arkansas who owns stablecoin can see that and saying, okay, I'm willing to fund that. He doesn't have to go and see where the money is going, how it's coming. He just knows that it's automatically happening, and you're able to generate that yield, right? My view is over time, that's what replaces, this is where RWA, et cetera, steps in, where then that balance sheet aspect that the banks have no longer is a moat, because now it becomes a worldwide crowdfunding platform.
It does. And it becomes a worldwide headache for regulators.
Absolutely. Absolutely.
Because I can imagine this happening within a certain level of a jurisdiction, and I think that's kind of where it'll start, which is a sensible way. And then we'll have to see how multi-jurisdiction interoperability of movement of money happens, and so on and so forth. So I'm cognizant of time very, very quickly. So what is it that you other players who come out of, I hate this term Web 2, Web 3, but who came from sort of, let's call it FinTech 2.0, right, are sort of migrating to FinTech 3.0. How do you see immediate use cases of digital assets, the wider family for you guys in your business?
Two elements. I'd say, so infrastructure-wise, very much as I just mentioned, is now tokenizing each of our loans. That's what we're doing to make sure that validity is there. Because that's the biggest problem you have really when it comes to emerging markets, right? Why do you have local banks? It's because they're the trusted institutions to be able to do KYC, to be able to do the lending and know that the transaction's happening. Once you're able to validate that and do that international scale, I think that's one aspect. So we're very much tokenizing on that aspect.
So you're tokenizing each loan.
Each loan.
And when you take the tokenization, are you then looking at sort of securitization?
Correct. So we work with now crypto funds, for example, that want RWA, and so we're able to then provide them with yield. On the
financial securities is the right place to go.
So that's
that I agree with you.
That
makes perfect sense.
Kind of very from a practical aspect. Second aspect of it, which is what we're looking at as well, is now on a lot of emerging markets. There's a lot of freelancers that work within those markets. They get paid abroad. They typically now are getting paid in stablecoin. So now we're using that as collateral to be able to provide them with remittance services domestically in their own country. So don't bring that capital in. We can actually just, like in SBLC, you got $100 of stablecoin abroad. You don't want to bring that in. I'll give you $70 of that domestically in local currency at a rate. Default on me, I collect on the stablecoin. If not, then you pay me domestically. I'm making money on both sides. So that's the more practical use that's happening as well today, given people's usage of stablecoin from working in from an emerging market angle. The third one will be eventually where I think we will actually replace our entire balance sheet completely away from private credit, crypto funds. It will become internationalized from a individual standpoint where it becomes a P2P transaction. And we will be just one platform business that allows you to connect to our different users, business or individual. Still a while away, something we're working towards, but that's the third aspect of it.
Okay, I'm going to pivot away. I'm going to bring back to something which sort of happened more recently. And so Pakistan was quite interesting, right? And we were in conversation during the time you did that. I also met, Kabir Naqvi, who was on the show, but at that time he hadn't joined you. He joined you, I think, post-Twitch. So what was the thinking around Pakistan? There's a lot of volatility in that market. I do know that, you have a certain connection to the country, so on and so forth. What made you say, I want to take this exposure into Pakistan, high risk market, so on and so forth? Or maybe I just got that wrong.
No, it's asymmetric risk, right? I think you always need to be looking where no one else is. And the problem is timing. I remember 10 years ago, no one wanted to look at Brazil. And now Brazil is the sweetheart when it comes to fintech overall. Different markets, same thing. For me, I think Pakistan's similar. We all know the top-down numbers, so I'm not going to regurgitate that. No. But the opportunity set is massive over there. And it's a market that will continue to be very strong for us and our bedrock. It's not only a large revenue driver for us, but from an operations perspective as well, as we expand elsewhere, it becomes a real powerhouse for us and a competitive edge for us as well, because we're able to be much more price competitive compared to our competitors who have singular operations in any of these other markets. So for us, I think, and why we continue to focus on it, is that there's so little that has been done. And the traditional banks have really only need to focus on government lending to be able to make the ROE that they want. For us, we think that we're barely scratching the surface, and our loan book size is now just about $110, $120 million in total in Pakistan. That is nothing. We can easily have $1 billion loan book in 2 to 3 years, and we still wouldn't have been scratching the surface. So for me, I think the opportunity set is massive. It comes with its ups and downs, but this is somewhere where if we fast forward 5 to 6 years, we could be sitting at a $10 billion loan book with ROEs of close to 35, 40%. And it's happy days. That's a compounding business. So that's where we continuously see a lot of opportunity over there, and we continue to invest there when the opportunity is right. So the bank, for example, at the end of the day, for us to grow, we need to be as close to our raw material as possible, which is cash. So the bank allows us to have our own deposit base until the whole crypto kind of story plays out. This is our easiest way to bring our cost of capital down. And so now we're deposit based is growing faster than even our loan bases.
And your investor community is comfortable?
Absolutely.
So they're open to the, I guess, the geopolitical risk which comes with investing in a business that has a certain amount of exposure, or are you isolating this business separately to saying that fine, we operate it differently?
Yeah, we're saying, look, it's self-sufficient. So no further equity capital. So any new equity capital that we've raised in the last 2 years, for example, none of that has gone towards Pakistan, because it is a self-sustaining business. It is able to support the rest of the businesses. And so we do not need equity capital there. It's just going to be a compounder.
So is then all the equity capital that you will deploy either now or in the future is GCC, or are you now looking to say, hey, I can replicate the model? Because I think what's quite interesting is that, you have 3 different models that I've counted already. Pakistan is unique. You're doing something different in Saudi. You're doing something different in UAE. And so, as you look at the wider, if I may say, North Africa, Sub-Saharan Africa, even look at Central Asia, I'm sure these models all kind of, one of the 3 models fits in.
Yeah.
So is this time to scale, or is this time right now to sort of, double down, scale what we have, and then we'll look outside?
Double down, scale what we have. 100%. So we're very much focused UAE, Saudi, and we're launching in Oman next month. Mm-hmm. These are our 3 core markets for the GCC at least, which we'll be focusing on for the next, I think, at least 1.5 to 2 years. Pakistan, like I said, is humming away. The macro's turned. Everything is like pointing in the right direction. It's kind of building its own empire over there. So for us, it's really saying, okay, let this continue to grow when it comes to Pakistan, continue to be able to support the rest of the businesses, but GCC needs to be our first bedrock before we decide to go anywhere else. Let's make sure we cut our teeth over here, build ourselves with brand equity and what we're trying to do over here, and then go elsewhere. If we spread ourselves too thin is when we're going to blow up.
And I totally agree with you. And I think that's where a lot of people have made mistakes. And, I've worked with a few of these founders who've sort of gotten ahead of themselves because I think they saw the numbers come through. I think they saw the valuation numbers come through, not necessarily the bottom line come through, and then kind of expanded yourself.
I made that mistake.
Yeah.
Bangladesh.
Yeah, I remember. Yes.
I went to Bangladesh thinking, yes, we're going to go. And we shut it. We ended up having to shut down, right? It was a bitter pill to swallow. But the point is, I went in way too early.
Yeah, and to be honest, there's no better way than fail fast, because I've seen a number of your peers here again who've done that. A lot of people from here ventured into Egypt, realized it was the wrong idea and came back, and thank God they did it early enough. Others who have stuck on, and no names to be taken, they continue to bleed, and it's actually become more of a sentiment sort of driven view that cannot be seen as losing. So let's continue to throw money at it. Last question. 5 years from now, are you, and again, I'm going to just come up with these options as the second thing. Are we a regional neo/digital bank? Are we, as you said, this incredible platform that's going to raise money in very unique ways and deploy them in even more unique manners? So I don't call it embedded finance platform, whatever else. Or are we some sort of a conglomerate group which has a number of different business models in different markets, and wherever the synergies can play, great, but wherever it doesn't, we maximize each market? Where's the thinking going?
So there's a famous saying, those who look into crystal balls end up eating shattered glass.
I lived that life.
I lived that life. So I straight away, because if you asked me 4 years ago, or 5 years ago, when we started the business, for example, where we are today, no way I would have been right.
Yeah.
So do I have a vision in terms of what we're trying to do here? Absolutely. It is to be a neobank across emerging markets. When we started this off, the whole idea is to become the neobank for emerging markets.
Yeah.
The timing of it, how it happens, when it happens, who knows? That is the ultimate vision. That is something we're striving towards, but bumps happen.
No, I know, but I agree with you, and I'm going to throw the challenge. I think it is important to have some form of what I call point of landing. There's point of departures, and the fact of the matter is, you said, things will happen which we don't expect, tomorrow, right? But because you are becoming bigger, the decisions that you're making are becoming more impactful. There's got to be some context against which you make those decisions, right? As you were younger business, you could make those quick decisions because the implications, like, Bangladesh would have costed you, but wouldn't have costed you. But imagine you would have gone into Bangladesh saying, I'm going to do the same thing as Pakistan and go buy a bank, right? Which would have been a much bigger investment. Today, you're kicking yourself a lot more and a lot harder, right? And I think that's important. So it's quite interesting, because I also do think that at the end of the day, you will need to have that sort of, I don't like using the word bank, but I do think that whole concept of bank, where you can raise money with ease and deploy money with ease, right? And do everything else that is required. Because I think more of your clients, and if you're going to play in this sort of micro, small, medium enterprise space, they don't want to deal with 10 different people, right? They want to deal with someone who they can trust and who can sort of grow with them. Yeah. It's very obvious to me that you made it very clear where you want to go to. I think Pakistan is fascinating for me because Pakistan is a market I know very little about, but every time I speak to, I kind of think that if you could get a certain level of political stability, just the numbers are huge, right? There's so much consumption that's there, there's growth potential, and you are underserved to the extent that is unimaginable. Thank you for coming.
Thank you.
We'll do it again in maybe 2 years' time. Hopefully, by then, you have some more interesting stories, and this whole crypto stuff becomes more clearer. I think it's getting clearer quite quickly, although I still think that there's more fog than there's clarity. But I guess at least LinkedIn makes us believe that it's all very clear, right? But we'll carry on the chat. Appreciate you coming in, and best of luck.
Thank you for having me on.
All right, ladies and gentlemen, that was Omair Ansari, co-founder and CEO of Abhi. Fascinating business, right? When I met him 2 years ago, we were predominantly an earned wage access player focused just in UAE. And now, he's across 3 markets. He's actually entered and exited a market. That takes an effort and a half. But watch the story. As in, I do kind of rate him as, in me, the top quartile of fintechs that we actually have in the market in the wider region. So with that, I'll say goodbye, and I'll see you next week. Bye-bye.